I'm Andy Guardiola, and I am Vice President and General Counsel of HELP, a small nonprofit here in Laredo, Texas, that is dedicated to helping families of low-income means, helping them with their education, dealing with finances, and similar things. So I'd like to talk to you today about qualified retirement plans. And I say qualified because it is a term. It is a term of art in tax law and under another law called the Employee Retirement Income Security Act, or ERISA. Qualified means that it is a retirement plan that is in compliance with tax laws and is in compliance with ERISA, the Employee Retirement Income Security Act of 1974. I thought it was important to start off that way in explaining and telling you about qualified retirement plans, because these retirement plans that people get into from their employers, and sometimes on their own, like individual retirement arrangements or IRAs, these are all regulated by the Internal Revenue Code, which are the tax laws, and by ERISA, most of the time by both, right? So ERISA provides federal regulation in connection with mostly fiduciary duties when it comes to retirement plans. And it came about back in 1974 because a lot of retirement plans, corporate retirement plans especially, were being abused. The trust funds that funded these retirement plans were not doing so well, and the ones that were, of course, being damaged by that were the employees, the participants in those employee plans. So ERISA was legislated and was signed into law in 1974, and as I said, it deals mostly with the regulation of the fiduciary duties of the trustees that run the plans. But it also regulates the funding, the participation, the vesting of the retirement plans, and how the benefits accrue, or how the money, the pool of money within the retirement plans are being managed and invested. And that's big, because if you don't invest the monies correctly, then the plan doesn't grow. So another very important part of it is that it established the Pension Benefit Guaranty Corporation. It is an offshoot of the ERISA regulations, in that it's another sort of agency that was established to protect the employees when the retirement plans that they were in were terminated or went bankrupt or what have you. But so the Pension Benefit Guaranty Corporation protects them. If something goes wrong with a retirement plan, then the Pension Benefit Guaranty Corporation steps in and funds their retirement. It reminds me of FDIC, when banks, and I think nowadays it's up to either $100,000, at least $100,000. I think it's went up to maybe $200,000 or $250,000, but it protects everybody that has a bank account in a bank that subscribes to the FDIC, or Federal Deposit Insurance Corporation. It's sort of like similar to that. However, ERISA does not cover it doesn't cover all retirement plans. It covers defined benefit plans, which I'm going to talk about in a minute, and it covers 401ks, which are part of defined contribution plans. It doesn't cover IRAs. It doesn't cover SEPs, Simples, 403B, or 457 plans. I'll talk about those in a minute. So I already mentioned defined benefit plans, defined contribution plans. Those, if you can throw all the retirement plans into categories. That's the two categories that would best describe all kinds of retirement plans for people. Defined benefit plans, first of all, are used mostly by government entities and the older, larger established corporations, like the old ones, like maybe General Motors or General Electric, DuPont, maybe. I'm not sure they have the defined benefit plans, but those are the kind of corporations that offer defined retirement plans for their employees. And I believe the only government entity that I know of is the federal government, who uses defined benefit plans for all their federal employees. So the defined benefit plans, what they do is they guarantee a certain amount for life, which sounds like most retirement plans, right? But the difference between the defined benefit plan and the defined contribution plan is that the defined benefit plan guarantees that income, but does it through a formula. And the employer follows this formula to determine the benefit that the employee is entitled to when they retire ahead of time. They know already what the employee is going to be getting as far as annuities, as far as a monthly payment or an annual payment, and so does the employee. So it's good for both the employee and the employer. But the employer does have to use, in a defined benefit plan, it has to use actuary companies to go ahead and figure out those formulas and to implement those formulas along with the trustee of the plan, of the retirement plan. So it's very costly, it's very expensive, and so a lot of companies don't like to do defined benefit plans, so they go other routes, especially the SEP and Simple for smaller companies that qualify for that, and for self-employed individuals also. So I mentioned this formula. It's a formula that's used by the employer to determine the benefit amounts ahead of time. The formula is based largely on the employee's years of service, the salary amounts over the years, and their age. But it's basically the employees' years of service and their salary amounts over the years that they've been working that they look at to formulate and calculate what they're going to get when they retire. But the employer itself is largely the one responsible for the administration, planning, and investment of the plan. So how are they funded? They're funded by the employer applying a percentage of the employee's salary to establish a tax-deferred account for the employee. And normally in these kind of plans, the defined benefit plans, normally an employee does not have to contribute. And that is not the case with the defined contribution plan, which by its definition is a contribution plan, right? The employees are required to contribute. And so in the defined benefit plan, an employee does not have to contribute, but some plans do allow for employee contributions. The defined benefit plan has no rollovers are allowed in that plan. It's a more just basically structured to not be that flexible. That's why over the years, recently, over the past 10, 15, or 20 years, it's really gone out of style, if you will. And more companies, more larger companies, and entities that provide retirement plans for their employees are getting away from the defined benefit plan, but they're still around. So of course, employer contributions from or within the defined benefit plan are tax deductible. That's the big, still the main attraction for a big company to do a benefit plan. They are tax deductible, and so the amounts they spend on funding the benefit plan, the defined benefit plan, is tax deductible. They do have to have a written plan. They do have to arrange for a trust to manage the plan's assets and create a good record-keeping system. Those are the things that, again, going back to the Internal Revenue Code, going back to ERISA, if these companies are going to have tax advantages and this is true for any retirement plan, if they have tax advantages, they have to have certain things that are required by the Internal Revenue Code and by ERISA. So the retirement plan trustee keeps up to date with the retirement plan laws, which are always changing, and manages the plan's assets. And the trusts are required under Internal Revenue Code Section 401A2, called the exclusive benefit rule. And Internal Revenue Code 401 is basically the code section in the Internal Revenue Code that governs pretty much all retirement plans. Then we come now to defined contribution plans. Those are the most popular. Those are the most common that are being used in the last 10, 15, or 20 years. The defined contribution plans are company-sponsored plans in which the employer commits to providing contributions. So it's going to be a matching contribution. The employer, for example, will say, okay, we're going to contribute 10% of your annual compensation, employee, and the employee agrees to also contribute to the plan. And the reason the employee contributes to the plan is because the most money that is contributed helps everybody, because it's not just a one-on-one contractual situation where an employee says, well, I'll take 10% of my salary, and then it's tax deferred for you, company, and then I get it when I retire and pay tax on the part that I have to pay tax on. The defined contribution plan is actually saying everybody bring in all their contributions, and it is pooled. It is a pool of contributions. The contributions are allocated among all the account participants, and so that's a buzzword used by the Internal Revenue Code to mean the employees that are going to be the beneficiaries of the plan, the participants. So they get to benefit from these larger pool of monies that are brought in by all the employers. The employees that are members of that pooled retirement plan. So they get to play with a lot more money, in other words, to invest and to help grow the retirement plan. The total contributions are allocated, so they keep track of who is contributing, of course. But all the money is totaled together in a pool so that they can invest it and have the retirement plan grow. It is done through an account value. The account value of the retirement plan of these in these defined contribution plans is actually what determines what benefits are paid. Remember, we talked about the defined benefit plan. It's already defined. It's already, the formula tells the employer and the employee what they're going to be getting and how they're going to calculate it ahead of time. Not so with the defined contribution plan. The account value is what the participants or employees will look at to see what it is that they're going to get later during retirement. In other words, when you, for example, a 401k, many people are familiar with 401ks. 401ks are a type of defined contribution plan. In a 401k, if you go into your account and you look at the money amount that's in the 401k, that is not the money amount. It's not like a bank account where you have, oh, that's the amount I have with my retirement plan. It's actually the value of your plan, which it's in dollar value, so it's pretty much almost the same thing, but it doesn't mean that you have that exact amount of dollars like you would have in a bank account, and you could go to the bank and withdraw that exact same amount because it says dollar amount there. It's the defined contribution plan, and for example, I'm using the example of a 401k, it has an account value. That's a little different than the defined benefit plan. So these investments that are made in these pools of money that make up these defined contribution plans, they are invested by the retirement plan administrators. And they run into the same regulations, of course, that ERISA requires of doing it in good faith, doing it and making reasonable efforts to invest that money wisely and the standards of a reasonable, prudent investor come in and require these trustees and plan administrators to invest the money as if it were their own. They grow tax deferred until the funds are withdrawn in retirement. That means that these investments are not taxed. The IRS will not come in and say, "Oh, this particular retirement plan has grown by 20% this year in 2020, so we're going to tax that." No, they as with most appreciated property that just appreciates, it is not taxed. So that's a big advantage of these retirement plans, because everybody wants them to grow, especially the employees who are going to be retiring and getting their monies in their retirement years. Of course, like anything else that sounds really, really beneficial, there's limits, and these plans have limits too. The limits to contribute, for example, for defined contribution plans are this year for 2020 $19,500. So that means a participant in a defined contribution plan is limited to contribute no more than $19,500 towards the plan a year. If you're 50, those employees and participants who are 50 years or older are entitled to catch up, what they call catch-up contributions, to catch up if they're behind, and so they're allowed a limit of $26,000 if they're 50 years or older. And so I'm sorry, I have the figures wrong. It's $19,500 for 2020 for everybody. If you're 50 years or older, it's $26,000 that you can contribute. Catch-up contributions are allowed with limits of $6,500. So theoretically, you could be 50 years, let's say 51 years of age, and so you're going to be looking at being able to contribute $26,000. And if you are catching up, or if you have a lower amount, you're allowed $6,500. So you could theoretically go in with $32,500 for the year. So after 72 years of age, however, there is no limit. You can contribute all the money you want to those defined contribution plans, like 401ks. They also have loan provisions where the participants can go in, ask for a loan, and they're usually very beneficial to the participant because they are very low interest. So 401k, I already talked about the 401k a bit. This is an example of a defined contribution plan, and it's called, the buzzwords within the Internal Revenue Code and ERISA is that it's an elective deferral plan. It defers money. It takes money from the gross income of the participant, puts it away tax-free, it's not taxed to the participant, and then at the end, when the participant is retiring, that's when that amount will be taxed. Usually there'll be amounts that haven't been taxed, and there'll be the contributions that have been the other amounts that have been taxed, so those are not taxed. And that's why when participants retire, there may be that when they get their 1099Rs, for example, if you're familiar with the 1099R, it'll have an amount that is usually in box 1 of the 1099R, and then right under the box 1, it has a taxable amount. That may be different sometimes, or sometimes it's zero. So you've got to figure out which part of your annual retirement amounts that you received for a certain year, how much of that is taxable, and you or your tax preparer have to figure that out. But anyway, it's funded through these tax deferred dollars, which are called pre-tax dollars and after-tax dollars. But however, if an employee goes, a participant goes, and these are further limits on these type of plans. The further limits are that sometimes if you go and you're not quite 59 and a half years of age yet, there will be penalties. And so these penalties are assessed on 10% of the amounts that are withdrawn, which were not supposed to be withdrawn. And that can have sort of a double hit on participants that do that, because not only will they be paying the 10% assessed penalty on the amount that's withdrawn that wasn't supposed to be withdrawn, but they then have to pay tax because it's a distribution. So they get a double hit there. Another kind of defined contribution plan is a 403B. A 403B, and it's called 403B. These type of plans, the 401k, the 403B, they're called what they're called, those numbers, because those are the Internal Revenue Code sections that apply to them. So Internal Revenue Code section for 403B, for example, provides that for retirement plans that mostly tax-exempt organizations use. Mostly schools that are tax-exempt use 403B. This is just a general discussion on retirement plans, so I can't get into why certain types of entities such as schools prefer the 403B, but all of that is in the Internal Revenue Code and other publications that the IRS has, for example, that can explain that. And the same is true for all these other retirement plans that we'll be talking about. Next, another kind of defined contribution plan is the 457 plan. The 457 plans are also defined contribution plans, but are mostly used by again, tax-exempt organizations, but more commonly by state governments and municipal governments. They are interesting because they have a feature that only Section 457 of the Internal Revenue Code provides, and it's called the double limit catch-up provision. This, essentially what it does is just it doubles the amount of contributions that you will be limited to. For example, in the 401k, the 401k limits you to $19,500 for 2020. The 457 plan doubles that if the employee is about to retire within 3 years. If they're eligible within 3 years to retire, then they can double their catch-up provisions and their so that they're in the last 3 years of while they're working, they can increase the value, right? The value of their allocated part of the retirement plan, so that they can be looking at more retirement or increased retirement benefits. Federal employees go through or offered a 401k type of plan. They call it the Thrift Savings Plan. Federal employees are very familiar with that. And these are essentially 401k plans. Other elective deferral plans that are defined contribution plans are SEP IRAs and simple IRA plans. I've already mentioned those because those are, I mentioned them when we were talking about ERISA and how ERISA does not regulate SEP plans and simple plans. It also does not regulate IRAs. And the reason the SEPs and simples are in there is because technically they're essentially IRA retirement plans. And these are very popular for small businesses. They are designed actually for small businesses, which include sole proprietor small business. A SEP is actually a simplified employee pension IRA, and it has higher contribution limits than the traditional IRA limits. The limit is the lesser of 25% of the employee's compensation, or $57,000. So you can see right there, right off, it's a lot higher contribution limit that applies to SEPs and simples. The limit on it is way up there at $285,000. That's the amount of compensation that can be used to calculate the lesser of 25% of the employee's compensation, or $57,000, whichever is less. So the simple is also a savings incentive match plan for employees of small businesses, and it requires that the business have less than 100 employees, and it requires that the employees have at least that each employee have at least $5,000 or more in compensation before they can get a simple plan going. Small businesses like SIPs and Simples because they don't have to go through the high costs and high bureaucracy of ERISA regulations. So it is a benefit to smaller businesses. And so when we're talking about all these defined benefit plans and defined contribution plans, we're also talking about not just tax deferment for the employer and tax deferment for the employee, which are benefits, but there are some certain credits out there that apply to these plans. For the employer, there is a retirement plan startup cost tax credit. It's 50% of the cost. The credit is equal to 50% of the costs that the employer goes and spends for processing, for initiating the plan, for the expenses of really everything that goes into the plan. It's up to $500 per year, and that is something that's thrown in as an incentive for employers to have employee benefit plans for their employees. Then we get to something that a lot of people are familiar with, individual retirement arrangements, or your IRA. There's two different kinds, traditional IRAs and Roth IRAs. I'm not going to be talking too much about the Roth IRA, although suffice to know that it is an IRA that is just as much a contribution plan as the traditional IRA, but it's got different rules. And the thing to remember is that the individual retirement arrangement or traditional IRA will have, like other benefit plans and other contribution plans, it has the tax deferment at the beginning. It takes money from the money must come from compensation that's required. Compensation for purposes of IRAs are wages, commissions, bonuses, professional fees, and self-employment net income. If you have that, you can set up an IRA. A traditional one means that you're going to have monies taken off your compensation at the beginning, and then when you retire, then you have those amounts are going to be taxed because they were not taxed at the beginning. The Roth is just the opposite. The Roth taxes you on any amount of contribution at the beginning, and then when you retire in your retirement years, you get to have monthly amounts paid out to you from the Roth tax-free. So you don't pay taxes on that retirement. And people differ in their retirement goals and how they want to live in retirement. So a lot of times tax plan with good tax planning and the use of either traditional IRAs or Roth IRAs or what have you, the individual can make better decisions with all these different kind of plans, make better decisions as to how they want to live in their retirement years. So the deduction for contributions on the IRA are $6,000 for a year, and that's for 2020. These are amounts for good for 2020. $7,000 if you're over age 50. But if your taxable compensation is less, then you're stuck with the lower amount of taxable compensation and not the $6,000 or $7,000. But if your taxable compensation is over $6,000 or $7,000, then you can go up to those amounts, $6,000 or $7,000. The good thing about IRAs is they give you an extra benefit to the IRA participant in that the contributions are considered adjustments to gross income. So the amounts reduce your gross income before you even get to other deductions and credits, including your standard deduction. It's called that sort of calculation on your tax returns is called above the line deductions. The IRA contribution is an above the line credit, so to speak, or adjustment, more precisely. It's an adjustment, and if you're familiar with your tax return, if you don't do your own tax return or you're a tax preparer, you'll know that IRA contribution, which is an adjustment, goes on Schedule 1 of your 1040. That Schedule 1, line 19 amount is your IRA contribution that is going to be above the line, and that goes to line 8A of the actual 1040. So that's a good benefit for your tax preparation planning. You can't do, now that I mentioned the traditional IRA and the Roth IRA, you can't do the 6,000 and 7,000 contribution for your traditional IRA and then go have a Roth IRA and have a contribution limit of 6,000 and 7,000, so that you would be, for example, if you're not age 50 yet, you can't contribute 6,000 to the traditional one and then 6,000 to your Roth. It's sort of the Internal Revenue Code considers if you have both, and this is just generally, right? If you have both, then it's going to be a total of 6,000 for both. So in other words, if you have 3,000, you want to give 3,000 contribution to one and 3,000 to the other, that's fine, because your total will be within the limits of 6,000, but you can't do 6,000 traditional and then 6,000 to your Roth IRA. And the final thing on these IRAs, when it comes to the deductions, they're also limited if you're covered by a retirement plan while you're still working. If you have an IRA and you also work and you're considered what the Internal Revenue Code calls a active participant in a retirement plan, which if you have a company sponsored one, most people are active participants in it, and so the deductions will be further limited by a complicated calculation that we're not going to go into right now, but it further limits those contribution amounts if you are a active participant in a different retirement plan, a company sponsored, like for example a benefit plan which is company sponsored or employer sponsored. It'll limit your deductions that you can take for your IRA. And one more thing, this is more of an employer consideration or IRA plan administrator concern that is unique to IRAs, and that is the following: that the IRA is considered a tax exempt entity. It's like a nonprofit, it's tax exempt. It doesn't pay taxes unless it runs into the Section 511 what is referred to as the UBIT rules, and these UBIT rules are just simply mean that if you get into making money that is just completely outside of the scope of retirement plans and how they invest and how they make money, you'll be taxed, sort of like nonprofit organizations are taxed. So these rules do apply to IRAs. We also have applicable to the contribution plans, distributions before age 59 and a half. I already talked about that a little bit. It is a 10% of, it's really an early withdrawal amount penalty. And I mentioned that is, in addition to the 10% penalty for distributions made before 59 and a half, you are taxed, it gets taxed, that amount gets taxed as a distribution. And so people might ask, well, why do they do that? I mean, it's my retirement plan, it's my money that I've been contributing, and my money that's been tax deferred out of my gross income from my wages, from my salaries. There are a lot of tax benefits to retirement plans. And when the Congress a long time ago came out with all these tax benefits, they did so in order to encourage people to save for retirement within their retirement plans. So the idea is to get people to put as much money away for their retirement as possible. But if they're going to be withdrawing these monies and not using them for retirement, then Congress, in its wisdom, is saying with these early 10% early withdrawal amounts, is saying, look, there's lots of tax benefits to these retirement plans, but if you're going to be withdrawing all your money early, then we're going to penalize you. So that's basically what is behind these 10% early withdrawal amounts. These are governed by Section 72T of the Internal Revenue Code, and these early distribution withdrawal penalties apply to any distribution from a qualified retirement plan. So it includes all these 401A plans, 403Bs, and IRAs. There's exceptions, and let me just quickly, I'm not going to go into too much detail with these exceptions because we're limited in time here, but they are basically, there's 6 of them, basically, right? So the one exception, one of the exceptions to the 10% early withdrawal amount is if you have a series of substantially equal periodic payments, and that to get to that, it's a very complicated formula that the Internal Revenue Code has to get to whether or not to decide whether or not something paid out before you're 59 and a half is a series of substantially equal periodic payments, and I'll leave it at that. The other exception is a distribution made to a beneficiary on or after the death of the employee. That's if you have an IRA and you're a beneficiary of the IRA, which, by the way, retirement plans have beneficiaries. It's very important for you to look at your retirement plan and check to see if you have, first of all, if you've done a beneficiary form. Fill out your beneficiary forms. Otherwise, if you were to pass away before you get your retirement, it's going to go to whoever the state of here in Texas, that whoever the state of Texas plans to give it to through their estates code determination. Or a lot of these plans also have their own, order of who gets the benefits if you haven't done a beneficiary form. So with the beneficiary form, you, the participant, decide who is going to get the money after you pass away. So if the distribution is made to a beneficiary on or after the death of the employee, that is not going to be have any kind of early withdrawal 10% penalty. The other one is a distribution attributable to employee's disability. That's self-explanatory. Disability will be defined also by the code. So that distribution attributable to an employee's disability will not count as a penalty. A distribution attributable to employees' medical care is also not, free from the 10% penalty. A distribution attributable to employees' educational expenses, those are for IRAs only. Only IRA participants are entitled to an exception for educational expenses. Distributions on early retirement after age 55, but those are only for 403B and qualified plans, but not for IRAs. Now, any talk on retirement plans has to have some sort of discussion on required minimum distributions. Required minimum distributions are governed by Internal Revenue Code section 401A9, for those of you who follow the Internal Revenue Code and read it often. No talk on retirement plans is ever complete without mentioning RMDs. They're very important because these apply to pretty much all qualified retirement plans, including 403Bs and IRAs. And what this means is that there comes an age, and nowadays it's 72. When you turn 72, you have to take distributions. It's required. That's why they call required minimum distributions. You don't have to take the whole thing, but there is a minimum amount that you must be receiving throughout the years of your retirement to comply with the we call RMDs, with the RMD rules of section 401A9. This does not apply to Roths. If you get a Roth IRA, this RMD only applies to participants after their death. So the beneficiaries it'll be more of a concern for the beneficiaries. Or in the case of people that have set up trusts, more of a concern for the beneficiaries of the trusts when Roth IRAs are in that trust as a method of funding. So, in other words, no lifetime MRDs apply to Roth IRAs. They only apply to the traditional IRAs and the other types of qualified plans. When is your first RMD? It's due on April 1st of the year after the person turns 72, and then December 31st of each year. So starting on April 1st of the year after you turn 72, you have to have RMDs. You have to get something distributed to you so that the government can start taxing you, right? So failure to take RMDs results in a penalty of 50% of the amount that was required to be distributed but was not distributed. That's a big hit. 50% of the amount that was required to be distributed but was not distributed is going to go to the government as a penalty. Some other items that are related to retirement plans are things I want to mention are rollovers, because everybody's heard of a rollover. When they talk about retirement plans, they like to talk about, well, I plan to roll over my retirement plan, and that's part of my tax planning. And the reason I mention it here in this discussion on retirement plans is because you have to be really, really careful with rollovers. You have to have what's called a trustee to trustee or direct rollover of let's say an IRA or some other 401k or some sort of contribution plan. I believe it doesn't apply to benefit plans, but it does apply to contribution plans. The ones we've been talking about, like, for example, the 403bs, 457s, and 401ks and IRAs. If it is not done precisely the way the Internal Revenue Code directs a rollover to be done, it can cause a distribution. So all of the amount that you think you might be rolling over will be taxed that year, when whatever it is that you're doing that might not comply with the code, whatever year you're doing that, it might be considered and deemed a distribution. So the whole amount will be subject to tax. And for those who have significant and substantial amounts of retirement money, let's say $1 million, you're going to be taxed one year on $1 million. So you want to avoid that at all costs. So you have rollover ambitions, talk to a certified financial planner, tax lawyer, CPA, because it's worth the money you're going to spend on that, so you can make sure that rollover is being rolled over properly. And so these concerns are also applicable to inherited IRAs. If you inherit an IRA, you've got to be careful how the steps will be taken to have the IRA retitled and retitled so that it ensures that it is titled to make clear that it is an inherited IRA and not anything else, not a distribution. So that's also important. And discussions on retirement plans, since it deals with a person's retirement, also has to come along with some discussion on Social Security, because Social Security is also a sort of retirement plan, but it's a much different. It's not governed by ERISA, of course. It's not governed by the Internal Revenue Code, except to the extent that it's taxed. But it's handled, administered, and by the Social Security Administration. So the Social Security has different rules than qualified retirement plan rules, and that we've been looking at. It has different retirement ages. It has a different way of funding the whole Social Security retirement pool of money, if you will. And that, I'm not going to get into that, but it's funded through mostly payroll taxes. The different ages start at 62. I believe that's the minimum amount, minimum age of Social Security that you can start applying, at which time you can start applying. With full retirement age, as much as 67 and a half for many, and it all depends on your date of birth and age. The average Social Security benefit, I just found out that from looking at the Social Security website, is $1,503. So I say that because it's important to consider that if you're just going to rely on Social Security for your retirement, then you can go ahead and just skip those 2-week vacations that you've always set your sights on when you retire, because 1,503 is probably not going to make it as far as comfortably retiring in your retirement years. You have to combine that, in other words, and that's why I throw in some discussion on Social Security, because you have to combine nowadays. You have to combine your retirement plans with what you're going to be getting with Social Security if you qualify for Social Security. If you have enough credits, if you've been working more than 10, 15, 20 years, it's probably safe to say that you do have enough credits and you do qualify for Social Security. But you've got to check that with the Social Security administration people or their website. Their website is very helpful. It contains a lot of publications and literature that you can. It's in plain English and you can understand, so you can plan for your retirement better with combining retirement plans and Social Security. Some of the benefits are taxed, and they will be taxed up to 50% of the benefits if your income is $25,000 to $34,000 or $32,000 to $44,000 married filing jointly. So anything above that is taxed at 50%. It'll be taxed up to 85% of your Social Security benefits if your income is more than $34,000 or $44,000 if married filing jointly. So you should be aware of that when you do your tax planning, and also be aware that if you work, because you can still be working and getting Social Security benefits after age 62. So if you work, Social Security will deduct $1 for every $2 that you earn from your work or employment or self-employment, whatever it is, above $18,240. That's a 2020 figure. $18,240 is the amount they go by for this year, 2020. And so anything above that is going to be deducted $1 for every $2 above. And so just a quick mention, this is the last item I have for our discussion on retirement plans, and it is that this year, of course, with the pandemic, with the coronavirus situation, Congress came up with the CARES Act. Back in, I believe it was late March or early April, Congress passed legislation that was designed to help businesses and individuals who are affected by coronavirus. CARES Act, when it comes to retirement funds, did the following thing. Eligible individuals, and that's defined in the CARES Act as basically, I'm not going to go into exactly, it's a long definition of it, but it's basically someone that's affected by the coronavirus, either has it, is hospitalized, or who has to take care of their children because of some other sort of coronavirus related event. Say, for example, the children can't go to their daycare or school because they are doing virtual teaching or virtual daycare or whatever, and the employee has to stay home. And so if that affects them financially, they're able to withdraw up to $100,000 from IRAs or workplace retirement plans, such as defined contribution plans. They can withdraw $100,000, which normally we've talked about how that would create, especially for people that have not reached 59 and a half, that would create a penalty, right? Or if not a penalty, it would create a taxable situation on that money that's withdrawn. Well, the CARES Act allows individuals who are affected to withdraw up to $100,000 to help them out. And this has to be done, however, before December 31st of 2020. Today is October 23rd, so many people that are looking to this to help themselves financially because of the virus, COVID-19 virus, to have only a month and a half left. This withdrawal it's not completely free. The withdrawal has to be included in taxable income over the next 3 years. So at least they're giving you giving the eligible individuals 3 years to pay the taxes on the withdrawal. There will be no 10% penalty, as there would be if you would do this, you would take these withdrawals in normal times. These withdrawals are not subject to the mandatory 20% withholding either of distributions. And if you later want to put all that money back, you're allowed to put it back within 3 years, and so you won't have those limited contribution amounts of of $6,000, for example, on the IRA, you can put back all the money you withdrew in 2020, and you have 3 years to do that. This includes 401ks and 403b plans. And so that's the end of my presentation. I hope that this was beneficial to you. I hope you learned something about retirement plans and can use it in your tax planning and your retirement planning. A bit of a disclaimer that I have to do is that this presentation was prepared in support of HELP's mission of providing community-based outreach type support to low to moderate income taxpayers. It is not written or intended to be used and cannot be used for the purpose of avoiding tax penalties. And anybody that is a recipient of this discussion should seek advice based on the recipient's particular circumstances from an independent tax advisor, which includes tax lawyers, certified financial planners, and CPAs. So with that, thank you very much. And I wish you the best of success with your retirement plans. Thank you.